So last week we touched on what it means to be an objective-based investor. We talked about why most people's common reasons for investing, i.e. make money, aren't specific enough to overcome the challenges most people are going to invest. This week we drill down more for better solutions on why theses to each individual position are so critical. What does it mean to be an objective-based investor beyond just having a generic why to having a thesis? That's the point that we're going to explore this week. And again, really what we're talking about thesis, what we mean is something more specific than just make money. Why is that? Well, if you look at what it means to be a successful investor, there's going to be a few things. Usually, the old adage, buy low, sell high. If you're buying low, by definition, you're buying something out of favor, something that most people think isn't attractive. If they did, it'd be high. And that's, again, not a great entry point. Secondly, patience. If that adage, if you're again, your goal, your thesis is, well, I'm buying this to make money, not every asset class, particularly if you're buying low, but really any asset class is going to make money all the time. So how are you then going to gauge, is it really working? How are you going to have the patience necessary when the timing of that individual position or your portfolio doesn't match up with the timing that you hoped that your thesis would come to fruition? That's why, again, having those well-defined reasons, something very specific that you can measure, is so critical to both portfolio construction and individual positions. So with that, let's walk through a portfolio and hopefully help bring this to light. One of the series of strategies we run here is our high income strategies. The name suggests we hope to generate a high income for our investors. That's our objective. That is the thing we hope to help our clients achieve, and it is the thesis then that drives the selection of the individual positions within the portfolio. Drilling down even more, how are we going to do this? Okay, one is income, obviously. Second, we want to reduce volatility. Most of the clients in this subset of series either can't emotionally or financially afford to take a high degree of volatility within their portfolio, so we want to use that as a guidepost. And then three, we want to have obviously long-term growth to offset inflation over time. How does this play out? Well, when we're going through and evaluating all the positions, whether they're stock positions, real estate positions, fixed income positions, alternative positions, we want to make sure they're either adding to or at least not distracting too much from our goal of having solid income stream. The second thing we want to make sure they're doing is helping us reduce volatility a little bit. And then for certain, not all, certain of the positions, we want to make sure they're going to add to long-term growth. So for those stock positions, whether they're domestic or international, again, we want to invest in managers that are going out finding great blue chip companies, maybe using other alternative strategies to enhance income. But again, over time, giving us long-term results commensurate with the indexes that they're trying to represent. That isn't necessarily our goal for everything else within the portfolio. If you look at, for example, some of the fixed income and alternative positions, they're there simply to provide income or reduce volatility. We don't have great long-term growth aspirations for those positions. So when stock markets are doing really great and these parts of the portfolio aren't keeping up with, say, last year's 20% gain in the S&P 500, we're all right with that, knowing that isn't why we bought them in the first place. There's a global macro strategy we use. It's just there to lower correlations. What does that mean? Not act like anything else. So yes, over time we expect us to give it some return and some income, but the main reasons it's there is, again, is to dampen volatility and to not act like the other things. So if those things really get beat up, we can sell it to average down. As I joke all the time with clients, you can't, if everything in your portfolio goes down at the same time, you're not dollar cost averaging, you're just shuffling, and there's no advantage to be gained from that. So global macro, not there for total return, not necessarily even there for income. Things like stocks, real estate, yeah, we hope to get more long-term growth there. But again, what are those specific objectives for each individual asset class to help build an overall great portfolio that maps for the specific needs of the clients. So in summary, believe me, I get the frustration at times of a strategy, again, more diversified. It's so fun when markets are strong to want to be participating in all that upside, or when markets are down, wish you had avoided all the downside. The reality is there's so many ways to be successful without torturing yourself with that type of hindsight. Trust this, if you're following a well thought out methodology, whether it's something like this, we obviously have plenty of other strategies that, again, go across the risk continuum for investors. You're so far ahead of most. Don't let those cocktail party stories, as I told them about the guy who got into Bitcoin or Netflix for pennies on the dollar, make you think that you're somehow failing or getting behind. The reality is for almost all those successors, there's the eventual snapback failure. It isn't, time has shown, a long-term, repeatable, successful process, and that's what we hope for you. We'll see you next week, where we'll delve a little bit into how you can measure the success of your portfolio.